Good Sunday afternoon, everyone. Thanks for watching. It is today, what is today? The 25th of June. Although if you live in Connecticut or New England, you certainly cannot believe it's summer, considering how crummy the weather has been here. Story for a different day. I've written about on the blog all the time. It is mind-numbing that we had such a mild winter, and now we haven't had essentially any nice sunny 80-degree weather. But I'm sure we'll get there. Mother Nature likes to even it out over time. Anyway, thank you very much for watching today. If you like what you see, please give me a thumbs up on YouTube. If you have any questions, comments on the material I cover, you're always welcome to send me an email, paul@investfortomorrow.com. And you can also call the office and schedule some time together. So I know I have not done a video in a while. I've done a ton of writing on the blog. So people say to me, I don't know if I get your blog. So I try to send it out to everybody, or a whole huge list, roughly once a week, every other week. If you get notifications of my blog 3 days a week, then you know you're on the blog list. If you don't like that, you can certainly email us or change it to something less frequent. If you want to get our blog roughly 3 days a week, I usually post Monday, Wednesday, or Friday, depending on holidays and my travel schedule. So if you want to get my blog 3 days a week, when you read the blog on our website, there's a spot on the right side that says, I forgot, sign up for, and you can check some things, like maybe as often as they come out. All right, so I know it's time to do blog videos when I get the same questions over and over, same comments over and over. So let's start with a couple of the really pressing ones. I don't know about pressing, but in any case, we'll talk about some of the common questions and comments I've received. A lot of people since March, we've had this banking issue with the banks that went out of business, and people want to know, what should they do with their money? I'm not telling you to take it out of the banks because they're not secure. Quite the contrary. I was emphatic in March, and I was one of the few. I said, I have zero concerns about any of the major banks. I think they're going to be absolutely fine. Would I have my money? Did I have more money at Republic or Signature or Silicon Valley? No, I didn't, and I wouldn't. But that's just me. My argument is this. If you have money in the bank as a safety net, as just to make sure something is there because it's more of a heart issue than this issue, why leave it in the bank's money market or savings account or CDs when you can earn more at the Treasury? So for clients, I've said, look, we can buy you 3-month Treasury bills, which are guaranteed by the full faith and credit of the US government, and they are yielding somewhere between 5.15 and 5.20%. They're 90 days. You can go on the Treasury end, which are, again, guaranteed, full faith and credit U.S. government. You're not capped at $250,000, but you can buy anything from 1 month to 30 years and everywhere in between. You're not hamstrung. What I tell clients is, look, I'm happy to do it for you. No fees, no expenses, no commissions, no nothing. We eat everything. You just get whatever duration. If you want a month or 3 months or 6 or a year or 2 years, whatever you want, it's all well and good. I'm happy to do it for you. You don't need me. You can do it on your own on treasurydirect.gov, treasurydirect.gov. No fees, no expenses, no charges, no commissions, no nothing. Some folks aren't comfortable doing it themselves. No problem. I can buy it for you at these weekly auctions, and everybody gets the same price. So if you're holding money in banks, you're not going to need it in the next 3 to 6 months, and it's more of your safety net. To me, for my money, I'd rather own Treasuries. And I've told a bunch of clients over the last 3 to 6 months have taken my advice and moved their own money into Treasury bills. And I continue to recommend that because the interest rates are so much more competitive. It should be good until the Fed starts cutting rates. Now, that kind of good segue into topic number 2. We came into 2023 Y'all know that I was among maybe the single most bullish person in the United States regarding the financial markets. I said stocks go up big, bonds go up, crypto goes up, gold goes up. Has anything changed in my mind? Stocks are going up. I love it. Gold has gone up. I love it. Crypto's gone up shockingly. Like in the first couple of months, it reached my 2023 highs. Bonds have not cooperated as well. I wrote about it on the blog, I think on Friday. We'll get to that in a minute. So I thought I said all throughout 2022, no recession. The masses are talking about recession last year. I'm like, no way. Data does not equal recession. I thought 2023 could see recession. I don't think so now. I haven't thought so for the last, 4 months. I think the earliest you'll see recession would be early to mid 2024. So why did I bring that up? Does it matter? Yes. When recession is imminent, the Fed is going to start cutting rates. Does it matter? Yes, because Treasury bill rates will begin to go down before the Fed begins to cut the Fed funds rate. So that's why I think if you're going to buy, 1 month, 2 month, 3 month, 6 month Treasury bills to get yields well over 5%, I think your runway is decent in that I don't think the Fed's cutting rates anytime soon. All year long, the market was pricing in that the Fed was going to cut rates, 2-3 times end of the year. And I've said it ad nauseum. That's nonsense. The Fed is not cutting rates this year. As critical as I've been of the Fed and Jay Powell, one thing I give them credit for is that they've been very clear. When they've said something, they've telegraphed it way in advance, and they've told the markets, look, you're looking for Fed rate cuts that aren't happening. I'd say this, the caveat is, if there's a global crisis, yes, the Fed's going to cut rates. Let's hope and pray there's not a global crisis. And I don't mean recession. I mean something really stupid like cowards flying planes into buildings in big cities, something really that crazy. No, I don't think it's going to happen. I don't think you can invest that way. The recession, not this year. Fed cutting rates, not this year. The Fed should stop. They should have stopped already. I'm going to show you a chart. This is not I'm going to share my screen. Just so we're all on the same page. And if you've read any time I've written about a Fed meeting, this screen, you've seen it all the time. The solid black line that turns to blue is the Fed funds rate. That's the rate the Fed sets. And the rest of the chart is the 2-year note. The 2-year note is the best indicator of where rates should be, not where they are. The 2-year note leads the Fed. So throughout 2021, the 2-year note began to go up, and the Fed didn't raise rates until early 2022. And throughout 2022, the 2-year note kept going up, 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 up. And finally, in November, the 2-year note and the Fed funds rate crossed. Just means they equaled each other. So that told me that was the beginning of the end of rate hikes. And then the economy kept doing well. We all know that the jobs market has been insanely strong. Few people have adequately described why. And the only thing I can come up with, so funny, I'm listening to my phone ring at 12:52 on Sunday afternoon. But okay. So the Fed funds rate is now at about 5%. We'll round down, call it 5. The 2-year note peaked right before the bank started defaulting and closing up shop, those 3 horrible banks. It collapsed down and it's come right back up. But this to me is really says since November, we should be at a neutral stance. The Fed should stop raising rates. The 2-year note should go sideways. And for a period of a couple of months to quarters, we should see this. Everything goes sideways. The Fed has said they are looking at July as another live meeting, a hot meeting, to raise rates again. I think they're nuts. And I've said it all along. I think they are They're always late. I think they're pushing way too far right now. Is an extra quarter point going to do that much damage? No, but it is going to do damage. So I think that the Fed should stop right here, let the 2-year note curl over and come down. And I'll say this, when the 2-year note, which is now at 471, certainly below 4 is a weakening economy and one that is getting closer and closer to recession. We're not there yet. Let me just change to the other thing about recession. And that is the yield curve, which and the yield curve, again, there's nothing sexy or exciting in that it's complex. It's just one interest rate minus another interest rate. In normal times, the 10-year borrowing rate is up, and the 3-month borrowing rate is lower. That's called a steepening yield curve. When the 10-year rate is below the 3-month rate, that is called inverted or upside down. You'll see here in the chart I'm showing you, the 10-year has been lower than the 3-month since October of last year. And now it is inverted by 1.67%. And just think about it. Again, yield curve, people make too much about the name and its complexity. It's not. If you're a bank, you lend long and you borrow short, meaning you lend people money at 10-year to buy a house, invest in a business, stuff like that. And then you borrow short by selling CDs. So in a regular economy, in a normal, healthy economy, the 10-year interest rate is at 4, the 3-month is at 3, 4 minus 3 is 1, the banks make 1%. If you're a bank and you borrow at 3, you lend at 3 and you borrow at 4, that's a -1. That means you're losing money on your loans. So if you're a bank, are you going to make those loans? ? And you all should say no. Who would lend money at 3 and have to borrow at 4? It doesn't make any sense. So what do banks do? Banks pull back on lending, and that's what an inverted yield curve is. And that essentially slows the economy down because banks don't give out loans, and that eventually puts you in a recession. An inverted yield curve is the most accurate predictor of recession, although it's not timely. It's basically 3 months to 24 months, which if you were investing money based on this, you can't do it. It's too difficult. 3 months, 24 months, you're like, well, that could be any time over 21 months. And yes, we know that. So it just puts us on guard that once you invert the yield curve, which we did last October, between 3 and 24 months, the economy is going to have a recession. Many people believe that. I believe that. Some people believe that the inverted yield curve, and look how it's so inverted. I believe not only is inverted to the biggest degree ever, but I also think it's inverted for the longest period of time. Some people believe that there is something else structurally going on in this market, and the yield curve is inverting for other reasons. I mean, I don't have any data to refute that. I don't believe it, but we're going to see. This is why we come to work every day. It's why this is so much fun. So I still believe that recession is coming. We'll see when, but right now the markets are not overly concerned. And remember, let me stop my screen. We came into 2020. So in end of last September, I was pretty loud banging on a drum, and I'm going to pull up some charts as I close because I know this is, I hate to do these long ones. Let's see. So here's the S&P 500. In late September, I had high conviction. I was pretty confident that the bear market was ending. And, by the middle of October, you can go back to the blog. I was pounding on the table almost every day. New bull market starting, new bull market starting, new bull market starting. I did not see this depth of this decline that came in December. I didn't think it was going to be 9%. I thought it'd be 5%, but that's what it was. Did it shake my confidence? Yeah, it did, because I didn't see it being 9%. And I'm thinking, in real time, which is what I have to operate in when you're here, I'm thinking, holy geez, I did not see 4,100. Now we're at 3,800. And I'm thinking, geez, I guess we could go back down to the old lows. I didn't see it. I'm like, I don't see it, but it's possible. And that didn't really shake me too much. Thankfully, the market gods listened, and we're off and running in 2023. Now, the masses, the majority, so many people came into 2023 all bared up. They thought the bear market was still alive. They thought recession was coming. Earnings were falling off a cliff. So, I'm going to just speculate and say hundreds of billions, if not low trillions of dollars were defensively positioned for stocks to go lower. What happened in 2023? Well, we took off in January. We had a monster rally. We had a pretty good decline in February. And then since that early March bottom, we've been off to the races in a big way. Think of all the people who were defensively positioned to begin the year at 3,800-ish, and the market is running away from them day after day after day, beginning in March. And you hear them on TV. I mean, they're the pundits that are on all the time, from SoFi and New Edge and folks that don't even manage money but write newsletters. So now what happens is they're like, okay, we're all right unless the market makes a new high above the February peak. Well, this is only S&P. Now what do we do, folks? Now that not only did it take out the February high, but also the August high from last year. If you're a person, man, woman, child, who came in all bared up that market was going down another 10, 15, 30%, it's 2008 all over again, the market's ripping higher, what do? You are, in plain English, screwed, because you either have to throw in the towel and chase stocks higher. That sucks, because if the stock market reverses, you're in trouble. You bought, I'm making this up, you bought at the peak, now the market pulls back, you're like, holy geez. What happens if you say, you know what, I'm holding to my convictions, we're going into recession, it's going to get really bad? Well, now the markets get going again into July, and now you're like, oh my gosh, now you have an existential threat in the industry, because your mutual fund company or your pension company is not going to let you sit through a monster run making no money. And that is the great conundrum for amazing market years like 2021, 2019, 2017, 2013, 2009. That was a lot of fun. 1995, the greatest investing year of the modern generation. That's the conundrum. So what are they going to do? They hope and pray every day for a market collapse. And that's a terrible way to go through life, hoping and praying for Armageddon. So I am still positive on the stock market. Clearly, I'm not as positive as I was back in September and October. I'm not as positive as I was in March, but I feel pretty good. I think this little pullback is ending right now. And into early July, the S&P 500, which is now at 43, 48, can tack on another 100 to 150 points. The NASDAQ 100, where all the fun has been, has had one of the epic runs of the generation. It has been fun and fantastic if you've owned it, which our whole aggressive growth complex has been long with leverage, and it's been a lot of fun. In those strategies, when we do really well with leverage, you make a lot of money quickly, and we do poorly, you lose a lot of money quickly. It's just how it is. But it's been one of the great 6 months of my 33-year career. It's been a lot of fun. what do I think here? I don't think the rally's over. I think the opportunity, though, I am so keenly focused on the small caps because, look, they've done nothing. I mean, they've really done nothing for a long. They had a horrible decline into June from their peak. Huge decline into June, down 30+%. And they've been just thrashing around. I think while we don't own a lot of small caps, that's where I think an opportunity is coming. So I've got a laundry list of both small cap mutual funds, ETFs, and stocks. I'm looking at something called CALF, C-A-L-F. I didn't do the homework yet, so buyer beware, but there's a lot of things I'm looking at. Let's see what else. So I do think we bottom right now and we rally into July and maybe get a little bumpier over the summer, but that's what I'm looking at. Again, gold. Here's gold. I think gold is bottoming right now as well. I think there's a really good opportunity coming in gold. We're down from 2,100 almost to 1,900 and change. Gold should be bottoming shortly, and I'm looking for gold and stocks to bottom this week. Bonds have been more difficult. I love this rally from the October bottom to into January and February was great. And now as the economy is not weakened, the phone just keeps ringing. It's unbelievable. I'm sure I bet it's one of my family members, but I'm just going to send them a text and find out if it's my family. In any case, sorry. As the economy is not weakened and jobs have been stupidly incredibly strong, the bond market has gone sideways to a tiny bit lower. When the economy begins to weaken, you're going to see bonds begin to really rally. If the economy does not weaken and we have this elusive soft landing, which I talked about for months, the stocks are going up 30%. So I gave that as my second favorite scenario. I thought stocks would be up 15 to 20 this year. And I think there was a plausible scenario to see them go up 30. That's where we are. All right. And I am going to close and say a lot of people have had conversations with me and they've asked me, I want to buy Apple. I want to buy Nvidia. I want to buy AMD. I want to sell Apple. I want to sell AMD. I want to sell Nvidia. So I'll say this. Here's Nvidia, which is up, from 100 to 440 this year. And my view has been this. After this big jump here from 300 to 380, 400, I think it's prudent, or I thought it was prudent, and I still do. If you began with, let's say you put 5% of your portfolio into Nvidia, and because of the appreciation, it's now 7% or 8% or 9%. My view is you absolutely keep your initial position of 5%, but you pare back. And it's up to you to determine how much you should pare back. I know what we've done, and we've pared back, for full disclosure, we pared back Nvidia, and we pared back some AMD. And I think we pared back some Broadcom as well. Oh, and we owned Soxel, which, it again did a double in a short period of time. We pared back Soxel, which is the levered version of the semiconductors. Is it the right thing to do? It works for me in the way I run money. I don't believe in trees growing to the sky, and I think when you accumulate massive profits, you don't keep it all in black or red, if this were to use a horrible casino analogy. I think if you're in Apple, it's the same thing. There's Apple. You pare some back. There's nothing wrong with if you bought a 10% of your portfolio position, it now is at 20 or 25 because of appreciation. There's nothing wrong with taking it down to 20 or to 15 and planting somewhere else. We did it with Tesla multiple times. Did I know Tesla would pull back when I did it? No, but I just think it was a prudent thing to do. This is not about gambling. It's about prudently managing portfolios. So that's my opinion of it anyway. So that was, let's see, I answered the question about the yield curve, about the economy. I'm still bullish on the markets. I'm still, I think, look, it's almost the end of the first half. If you want to, let me stop my screen share. If you want to know what I would do, and I have right sitting next to me, it's got personal information on it from clients, but we've had a number of clients who've done two things this year. Some have said, look, I want to get more aggressive, in which case, after a big run, I put them on a list and we wait because I don't want to take more risk into a melt up, which is what we've had, a melt up. And I've had clients who we've reviewed their portfolios and they've got some strategies that have done just phenomenally well that look like returns you normally see over a period of years. And what we do is I move from something super aggressive into something either conservative or something in the middle, not with the whole amount. We take some profits away and then we replant them in areas that have not done so well, like dividend investing this year. Banks, utilities, energy, they've all done poorly. So our dividend portfolio is treading water, which is exactly what I would actually doing better than I would expect. But my point is, most importantly, that's a place I would plant, where on the aggressive growth side is a place I would prune. Just good risk management. Is it perfect? Of course not. But I think it's just prudent. And if you're if you feel much better about the markets after we've melted up, of course, you're getting that FOMO, fear of missing out. I get it. But for me, I would not throw money to the wind. Now, the NASDAQ has pulled back a little bit. Yeah, could you put a little bit? Sure. But I go hog wild crazy? No. I like the risk reward a little better elsewhere. And that's what I believe. So it's a long video. I apologize. I was going to do a bunch of little ones. So those of you who stayed till the end, thank you. I appreciate it. Golf clap. If you like what you watch, please give me a thumbs up on YouTube. Please contact me with any questions or comments. You can call the office. You can email me. If you want to set up a meeting, you can go to my online calendar. I think it's Schedule with Paul. And you can see all my times I posted through, I think, August in there. I don't post my evening meetings or weekend meetings, but I'm always happy to meet weekends and evenings. So I thank you for watching. I hope you're well. I hope New England gets low humidity, sunny, and blue skies soon. Take care. Bye-bye.